Hello dear traders, welcome back. Being the member of few social media groups, yesterday I saw many traders, many members of that groups were crying in regards to the CPI data being released yesterday. Why? Because their accounts were annihilated, their capitals were washed out, they were deceived by the banks, hedge fund, by the smart money in the market. Why? Because the smart money, the institutions, the commercials used the CPI data as a smokescreen and they kicked out the retail traders from the market. They used their liquidity, their capitals as a push to drop the market to the downside. In this session, I am going to explain how to trade the CPI data properly and how to not let the market deceive you next time. This was the time the CPI data was released. The CPI data was released on this candlestick. Before I explain it technically, let me show you the CPI data. Let me take you to the economic calendar. So this is the yesterday data in the economic calendar. So as we can see, the data shaded in the red were high impact news in the market, that is core CPI, CPI, and last one also the one is the first two are actually turned out the same as they were forecasted, as here 0.2%, and the actual data was also 0.2%. The second one is also having the same actual data, which is also 0.2%, and as it was forecasted in the market, 0.2%. So the first two data were not having a huge impact on the market because it turned out the same as it was forecasted. The last one which were forecasted 3.0%, but it turned out, the actual data turned out as 2.9%, which was less than the forecasted data. So what does it mean? It means that this data was negative for the dollar, United States dollars, and all the currencies, that is the euro, cable, even stocks, and for the gold, it was a sign that it was an indication that the market needs to rally to the upside. So let's have a look on the chart. The market dropped. How much it dropped? The market dropped more than 300 pips, and almost nearly the market dropped to 400 pips after the release of CPI data. Why it happened? Why the market didn't clear the all-time high? Why it didn't create the all-time high after the data was in the favor of the market rallying to the upside? The reason is simple, because the CPI data, the NFP data, the PPI data, they are used by the market makers, by the institutions as a smokescreen to kick out the retail traders from the market. They actually get the data before the data is released. They know what is happening, what data will come out on which specific date. So let's have a look. This was the early chart, 60-minute chart. Let me remove the last one. The market cleared this high, then the market cleared this high too, took the buy side liquidity from both of the highs. Let me take you to a smaller time frame to show you. Let me zoom it out a bit. So the data was released on this down close candlestick with a bigger wick to the upside. What happened? They first pushed the market to the upside. So whenever the market cleared the first side liquidity, like the market cleared the buy side liquidity, and when it comes to the downside below the lows in the market, so it is indication that the first side liquidity which was taken will prolong the opposite side movement, and that is what we saw in the market. The market dropped almost 350-400 pips after the first side liquidity, which was the buy side, was taken. So how it works now, let me take you to even a smaller time frame. Yes, with this pin bar the CPI data was released. What happened? It took the buy side liquidity. Now it came to the downside. So what is happening? First of all, the stop losses resting above these highs above here are cleared by the market. All the traders, the retail traders who took entry in the market before the data was released, they are now out of the market. Secondly, when the market started moving lower, now the retail traders were anticipating the gold to break all-time high. Why? Because the data was negative for dollar, and as a result it was needed for the gold to rally higher, because they are having the United States dollars and gold is having negative correlation, inverse relation. So they were buying at this phase. Now they are believing the market is going to break this high and make an all-time high, but it didn't happen. Where the market reversed, let me zoom in. Let's pull out the Fibonacci retracement. Guys, look at this. The market didn't went above the 50% level of the Fibonacci retracement on closing basis. It means not a single candlestick closed above the 50% of this previous wick. So it is an indication, and believe you me, I took an entry at this point because I missed this entry. I was looking in the cable in the Euro USD for entries, so I missed this one. But again the market dropped. Now the traders, the retail traders, were buying again at this point. Why? Because they were thinking of this area is a strong support, as they are teach in the retail trading mindset. This area is a strong support according to them. But I took several entries at this point. Why? Because this is an inefficiency in the market in the form of sell side imbalance and buy side inefficiency. It was a fair value gap. I took entry at this point and I waited for the market. How much I waited? Let me show you. I placed my stop loss above this high, because if the market is breaking this high, then I am sure the market will also break the previous high with the wick. But the market will not bother to break this high. So I placed my take profit below this low. Why? Because let me move to the M15 chart. My take profit target level was below this low. Why? Because I knew in this phase of the market dropping, the retail trader will be still buying. they will be thinking the data is in the favor of the gold to rally higher, and they will place their stop losses at the area where I am placing my profit target. So the market will definitely clear their stop losses in the form of sell side liquidity. So it was not the area where I anticipated that the market will reverse to the upside, where I anticipated the market. Let me show you. First area was, let me first remove this. First area I was anticipating the market was this down close candlestick, and I was anticipating that this area will work as a bullish order block. The market went below this bullish order block, even it went below this low. See, look at the wick. Even it took the liquidity resting below this low. So let's have I hope you can see the small fair value gap. It is an inefficiency in the market in the form of buy side imbalance and sell side inefficiency that is resting below the previous order block, and that is below the previous that is below the low. So the market also cleared the low and filled the inefficiency in the form of buy side imbalance, sell side inefficiency. That is how the market works all the time. It uses the high impact news, the fundamental events, the data that release in the market as a smoke screen. All the data in the form of non-farm payroll, CPI, PPI, they are all used as a smoke screen by the market makers. So now I hope you know how it works, how the market uses the data, and I hope you will not be deceived next time by the market. Till talk to you to the next time. Take care.